Welcome to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into ITG, Incorporated, trading under the ticker ITG. ITG is executing an initial public offering targeting an enterprise value of $3.2 billion, marketing a massive $2.9 billion backlog and a 48.15% revenue growth rate. However, this strategic debut creates a severe structural tension, operating as a defensive capital extraction and deleveraging mechanism for private equity insiders rather than funding offensive organic expansion. So, in plain English, the private equity insiders are basically cashing out and, they're structuring this whole deal so that you end up holding the bag.
Yeah, exactly. It's a textbook setup for anyone who studies market cycles.
Yeah.
Because on the surface, the company has constructed this incredibly glossy narrative. Wall Street is currently pitching this specific offering as like an opportunity to get in on the ground floor of the artificial intelligence and data center infrastructure boom.
Right, the whole AI hype train.
Precisely. They want you looking at the horizon, right? Not at the actual engine of the company.
Which is why you, as the listener, really need this deep dive. Our mission today is to cut through that shiny Wall Street marketing pitch and uncover the structural reality buried deep in the S1A SEC filings. We're going to examine the actual mechanics of this vehicle before you even consider paying the sticker price.
Because, the moment you move past the executive summary and start reading the actual footnotes regarding their operational efficiency, well, a very different picture emerges.
Okay, let's unpack this. To understand why this IPO is really just a defensive deleveraging event, we first have to lift the hood and examine ITG's actual operational engine. We are talking about a major margin compression audit here. Because, on paper, if you just glance at their top-line revenue, they look unstoppable. But the mechanical variables behind that revenue baseline are flashing bright red. If you isolate the accounting math, their gross margins actually dropped from 19.24% in 2024 all the way down to 15.83% by early 2026.
Yeah.
So they're bringing in more money, but the cost to actually deliver their services is eating up a significantly larger chunk of that cash.
And that drop in gross margin is happening simultaneously with an absolute explosion in corporate overhead.
Wow, really?
Yeah, when we look at their selling, general, and administrative expenses, what analysts call SG&A, it's scaled rapidly from just 5.2% up to 7.7% of their total revenues.
I want to pause there because a jump like that in corporate overhead for a company operating at $1 billion scale is enormous. What is driving that operational friction? Because usually when a company scales up its revenue, you'd expect economies of scale to kick in and make them more efficient, right?
Yeah.
Not less.
Well, you would expect that in an organically growing business. But ITG hasn't been growing organically. They are backed by a major private equity firm. And their strategy has been to aggressively roll up 12 different private equity-backed acquisitions.
Wait, 12 different companies?
12. They are essentially buying top-line revenue growth. So the company looks large enough to justify this public offering. But think about the mechanics of merging 12 distinct businesses.
Right.
You've got 12 different human resources departments, conflicting payroll software, overlapping management.
Right, you aren't just merging balance sheets, you're merging actual people in totally incompatible systems.
Exactly, and that is what integration friction looks like on the ground. When a technician in the field has to use like 3 different legacy apps just to log their hours, you bleed efficiency. So they're paying a heavy premium in administrative chaos just to artificially inflate that top-line growth number.
So the operations are basically getting less efficient by the day. But if the margins are shrinking and overhead is ballooning, how are they selling this growth story to public investors? Well, they heavily promote their backlog.
Right.
They point to this massive $2.9 billion total backlog. But let's look at how solid that number actually is. Because frankly, I view it more as a wish list than guaranteed income.
And that's exactly how you should view it. The underwriters make it the centerpiece of their roadshow. Whenever retail investors hear the word backlog, they naturally assume it means money in the vault.
Yeah, but we need to reconcile that fast-growing $2.9 billion total backlog against the non-binding nature of their contracts. A huge portion of this is tied to master service agreements, right?
Yeah, MSAs. And when you read the fine print of those agreements, 92% of their total revenue is tied to MSAs that carry 0 minimum volume commitments.
Wait, 0?
0. Meaning the client doesn't legally have to spend a single dollar if they don't want to. Furthermore, Clients can cancel or adjust these agreements on incredibly short notice.
Wow. So it's basically like having $1 million worth of items sitting in an online shopping cart. It looks great for the metrics, but until the customer actually clicks checkout, you don't have any real liquidity.
That's a great analogy. And that brings up the conversion timeline, which is where the conversion friction really drags down their near-term deployment execution. Out of that whole $2.9 billion total backlog, only $1.3 billion is actually slated for execution within the next fiscal year.
So less than half. And what happens during that administrative delay?
They're paying for idle labor and fleet costs. They have to maintain readiness, so they bleed cash waiting for these non-binding contracts to materialize.
Here's where it gets really interesting. Because if that backlog isn't immediately converting to cash, how is the company surviving day to day? Let's run a strict forensic balance sheet and debt audit here.
Oh, this is the most alarming part.
It is. The mathematical reality is staggering. Based on the filings, ITG is carrying $766.25 million in total debt obligations.
Yes.
And against that massive debt pile, they had just $1.6 million in cash and cash equivalents.
It's an incredibly tight liquidity position. I mean, it barely covers a rounding error in corporate payroll.
Wait, really? A company with thousands of employees and subcontractors only has $1.6 million in the bank? How do they even keep the lights on?
Well, they rely on immediate cash burn velocity. And this is documented in a shocking footnote from the S-1A filing. Right after closing the first quarter of 2026, the company turned right back around and drew down an additional $57 million of variable rate debt under its revolving credit facility.
Unbelievable. So they're on a capital treadmill.
Exactly. They're basically planning to use public IPO money to pay off the corporate credit card, only to immediately swipe that card again for tens of millions of dollars just to fund daily operations.
So, with crushing debt and virtually no cash reserves, the company desperately needs its current revenue streams to be bulletproof. But mapping out the structural risk powering their core revenue line reveals the exact opposite. We're talking about a severe concentration trap exposure.
Right. If we connect this to the bigger picture, diversification is your only real defense mechanism in this industry. But ITG has extreme customer concentration. Just 2 clients, Comcast and Charter Communications, accounted for 60% of ITG's 2025 revenues.
60% from just 2 clients.
Yeah. And that exposure totally prevents the business from controlling its top-line destiny. Their financial health is tethered directly to the capital expenditure spending budgets of 2 telecommunications providers.
I mean, I want you, the listener, to just imagine that for a second. Imagine the risk of having 60% of your personal monthly paycheck tied to 2 bosses who can terminate your contract with absolutely no advance notice, and you have 0 backup job prospects. That's the exact risk public investors are absorbing here.
Because if Comcast or Charter decides to cut costs or pause a fiber rollout, ITG has no alternative revenue streams to pivot toward.
Okay, so if the operations are fragile, the balance sheet is basically bleeding out, and the revenue is wildly concentrated, why are public investors being asked to buy in now? And who actually benefits from this capital allocation?
To answer that, we have to look at the insider playbook. Specifically, we need to dissect the company's structural Up-C architecture.
Right, the Up-C model. Break that down for us.
Well, under this Up-C structure, public investors, meaning anyone buying shares on the open market, are contributing over 71% of the total cash consideration for this offering.
Okay, so the public is bringing 71% of the real money to the table. And what do they get in return?
They are receiving just 16.1% of the corporate voting control.
So you pay for almost the entire house, but you aren't allowed to pick the paint colors or change the locks.
Exactly. And the inequity gets even worse when we look at the dilution illusion. Wall Street is asking the public to pay a massive $20.50 public offering price.
Right. But what did the legacy insiders pay?
The private equity insiders hold an average cost basis of just $1.57.
$1.57 against $20.50 for the public.
Yes. And because of that huge gap and the massive debt load, this exposes new shareholders to an immediate $20.69 net tangible book value dilution, which actually leaves them with a deficit of 19 cents per share.
So you are basically paying a luxury premium to acquire a negative net tangible asset base. You're buying a hole in the ground.
It gets worse. We have to talk about the Tax Receivable Agreement, or TRA.
Oh, yeah. The TRA is always a massive red flag. Explain how this long-term cash drain
Well,
works.
this legal agreement binds the company to take the tax savings generated by this structural setup and pay $346.2 million in cash out to the private equity insiders over a 15-year horizon.
Wait, so the tax savings don't even stay with the company to pay down that massive debt?
Nope. They are drained right out the back door to the legacy insiders. It drains cash that should absolutely be used for organic compounding.
It's literally like buying a house, but legally having to mail the previous owner 85% of your property tax deductions for the next 15 years. It's completely engineered to extract capital.
Exactly.
So what does this all mean? Let's synthesize all of this data and put a final price tag on the risk. Because we need to look at the valuation disconnect here. If we assess the investment case against a public peer, like, say, Dycom Industries, how does ITG stack up?
Well, ITG is currently demanding an enterprise value to EBITDA multiple of 23.
23 times earnings.
Yeah. And my final verdict is that a 23 multiple is far too demanding for an operator producing a negative 0.67% trailing net margin, not to mention a negative $89.7 million trailing free cash flow hole.
Especially when you consider that a peer like Dycom actually operates profitably.
Right, Dycom is stable. ITG is essentially a highly leveraged, sponsor-controlled asset attempting to command premium peer pricing before stabilizing its underlying cash generation.
It's incredible. And they still have massive primary execution risks moving forward, right?
Absolutely. You have the persistent customer concentration we talked about. You have ongoing labor scarcity bottlenecks because it's hard to find skilled field technicians. And crucially, they have major political exposure to regional data center construction moratoriums.
Which brings up one final provocative thought I want to leave you, the listener, to mull over. ITG is heavily marketing themselves as this cutting-edge AI and data center infrastructure play. That's the entire narrative they're using to command that premium 23 times valuation.
Oh, sure.
But when you actually read the filings, they reveal that 93% of their engineering and maintenance revenues come from jobs under $500,000.
Yeah, that's a massive disconnect.
So ask yourself, if Wall Street is paying luxury prices for an AI hyperscale builder, what happens when the market realizes this company is mostly just an outsourced maintenance crew doing small residential drop-and-bury cable repairs?
That is the multi-billion-dollar question.
Risk defined, portfolio protected.